Welcome to our session on stock valuation. We're going to look at a corporation or a company that is owned by shareholders, run by a board of directors, and want to discuss how to evaluate the stock. So we have two types of stock in a company. We have what is called preferred stock, and we have what we call common stock. Preferred stock and common stock. So what can you tell me about the two types of stock in their characteristics briefly on what you know? Discuss common stock and preferred stock. Anyone? So when we're dealing with common stock equity, I'll explain it in terms of the following variables. Number one, let me start with preferred stock. So preferred stock, as the term preferred, is a kind of stock that has preference, usually has a fixed dividend at the discretion of the board of directors. So preferred stock has preference over common stock in terms of payments and dividends and claims. So this kind of stock has no voting rights. So here the preferred stockholders generally don't vote, meaning they cannot influence corporate decisions. In order of liquidation, they are usually given priority in an event of a liquidation or bankruptcy. So preferred stockholders usually claim a higher claim of the company's assets than the common stockholders. So they are still subordinate to the creditors, but they get a higher claim. So in terms of risk or volatility, preferred stock tends to be less volatile than common stock because of its fixed dividends. We have two types of preferred stock. We have those that are called cumulative and non-cumulative preferred stockholders. So if you are a cumulative or a non-cumulative preferred stock will accumulate in unpaid dividends. So we also have convertibility. Some preferred stock can be converted into common stock, allowing the investors to benefit from the capital appreciation, capital gain. Preferred stock also has a par value or face value, and it has a valuation that we're going to look at in here. So these ones are usually given preference over common stock, meaning when dividends are declared, we will give the preferred stockholders first. We also have hybrid characteristics for these preferred stockholders, which have a combination of both equity ownership and debt ownership. So when we're doing our ratio analysis, these are also called private debt capital. So they make a unique kind of investment which appeals to many. Then we look at common stock. Common stock, like I said, is also called equity. So when we're dealing with common stock, we are looking at the residue ownership in terms of position in the corporation. We use a pro rata basis when we are looking at the payments. So dividends are paid out of the pro rata share earnings. So whatever remains is what the shareholders will get. So they own voting rights. They have the right to vote, meaning they make decisions that will influence the firm. Under dividend policy, the dividend payments under this structure makes the common stockholders to receive dividends if the company decides to distribute the profits to its shareholders. However, the dividend payments are not guaranteed. Sometimes it's a bad year, you don't get anything. Sometimes it's a very good year, you get the residue, which is big. In terms of risk and volatility, we assume that the common stockholders are more volatile than the preferred stockholders. In terms of the market fluctuations, when the prices will rise or fall significantly in the short or long run, it will expose common stockholders to a higher risk. We also need to understand that these don't get a fixed dividend. Unlike the preferred stockholders, common stockholders may not have a fixed dividend. They vary depending on the profitability of this firm. So they have limited liability in the sense that any potential losses, they are limited to the amount they invested in terms of shares. Convertibility, the common stock cannot be converted to another class, unlike the preferred stockholders. So briefly, I needed you to know the characteristics of this kind of stock that we are discussing now. So there are different models that we're going to look at in evaluating a stock. So I'll take you back briefly to time value of money, where we're discussing issues of future value. And that formula is what actually makes up the value of stock. Remember, the future value is given by what? Present value, 1 plus r at the power time. Now, this is what we're going to use in our dividend model when you're discussing the value of the dividend in year 1. It is simply dividend in year 0, 1 plus growth, which is our rate, the power, the difference in years. So here, if the difference in years is 1 and 0, we're going to get a 1 there. So if you have dividend after 2 years, we're going to say this is D0, 1 plus growth to the power 2, because the difference in years here is 2. We're looking at dividend for 3 years. We're looking at the D0, 1 plus growth to the power 3. Sometimes they will want to refer D4 with respect to the previous year, which is D3. So here we're going to have 1 plus growth to the power 1, because the difference in years here is 1. So this is a principle coming from the time value aspect. So whenever we are told that D0 has been given, meaning a dividend has been declared now. So let's assume that we have dividend 10 kwacha, and your growth rate maybe is what? 8%. We're going to calculate using the constant growth model, calculate D1. So D1 in this case would be what? D0, 1 plus growth power 1. So here we have 10. Our growth is 8%, so 1.08 the power 1. So this will give us a dividend of 10.8 for year 1. I want to be as basic so that you understand what is yet to come ahead. So how do we get D2? 10 plus 1.08 to the power 2, which is going to give us a value of 1.08 to the power times 10. So we're going to get 11.66. D3 will be D0, 1 plus the growth rate, 8% to the power 3. So 1.08 to the power 3 times 10. So to give us 12.59. But again, look at how I'm going to do D4 in 2 ways. I can simply say D0, 1 plus growth to the power 4. Or if I want, I can say D3, 1 plus growth to the power 1. Because the difference between the 2 years is 1. So are we going to get the same answer? Let us see. So here we're going to have 10, 1.08 to the power 4. And here I'm going to say the D3 we got, which is 12.6 and 1.08 to the power 1, because it's coming from the previous year. Let's see if we're going to get the same answers. So 1.08 to the power 4 times 10, we're going to get 13.60. And 1.08 times 12.60, and apply these two, as we're getting 13.60. So this is ideally the same, and we're going to appreciate it in the models available when we're calculating the value of stock. So the dividend valuation models that we're going to have in calculating the value of stock now is simply the summation of the present values. So we have the dividend growth patterns that assume that dividend valuation model will require a forecast of the future cash flows. So we have the constant growth, no growth, and the multi-phase, which we call the growth in phases. So I'm going to use the constant growth model to calculate the value of stock now. So to calculate the value of stock, we are given the valuation model, which simply says the value of stock now is simply D1 over K minus what? G. Or we know that D1 is the same as D0, 1 plus growth to the power K minus what? Minus G. Where K is what? The appropriate discount rate. And G is what? Growth rate. And D0 is what? Dividend now in year 0. Then D1 is dividend in year 1 or after 1 year. So you need to be careful with the English that is given in the exam question. So now let me pounce on this. We look at our examples in valuation of stock and apply the principles. So we've been given this question here. Let me beam it here so that we could digest it. So Lafarge stock has an expected dividend growth of 8%. So what are we given here? Our G is what? 8%, 0.08. And we are told that the share just received, whenever you see just received, meaning D0, a dividend of what? 3.24. And appropriate discount rate, meaning our K is what? 15%. Or 0.15. So calculate the value of stock now. The value of stock now is V0, or sometimes we can say the price of stock now. It's the same thing. So this is what? D0, 1 plus growth over K minus G. So in this case, 3.24 is our D0, 1.08 is our 1 plus the growth rate. Then our market rate or appropriate discount rate is 15%, and our growth rate is 8%. So we want to calculate the value of stock now. So when you calculate the D1, it is D01 plus growth. It's going to give you 3.5. Then K minus C is 15% minus 8%. So we're going to calculate the value of stock as 50 kwacha. So this is a computation of the value of stock using constant growth model. All right. Let me alter the question for you to see whether we get the principle. Let me alter the question to see whether we get the principle. Suppose instead we are given what? The following question. British Council of Zambia has an expected growth rate of 0%. Each stock has just received an annual 3.24 dividend. The appropriate discount rate is 15%. What is the value of stock now? What's the formula of value of stock now? Anyone? V0 is called what?
The price of the stock, which is D0 bracket 1 plus G divided by the discount represented by K minus growth, which is G.
And what are we given in this?
Here we are given the price of the dividend is 3.24. So we are going to multiply 3.24 open bracket.
What else are we given? The growth rate is what?
Growth rate is at 0%.
And the K, the market rate?
15%.
So here we're going to have what? 3.24, 1 plus 0% over our K is what? 15%. 15% minus 0%. So this will just give us on top 3.24 over 15%. So you can discover that the 0 is in essence, not affecting the computation in a way. So this is under a zero growth model where there's no growth in the dividend. So this equation sometimes is manipulated as follows. When you have zero growth, sometimes you are as good as saying the value of stock now is simply D1 over what KE. So our D1 is actually our D0. So you just have 3.24 over 15%. It's acceptable when the growth rate is 0. So this is the formula that is usually taken when we have a zero growth model. Ideally, it's just an issue of math. So you can do that if you want the normal way, you're going to get 21.6. So this is the growth model, constant growth or zero growth model. But for the exam purposes, what I'm interested in so much is this kind of model where we have the multi-phase. Now I want you to listen to me very carefully. Suppose you have dividend declared now as 10 kwacha. And we are told that the growth for year 1 to year 3 is what? 8%. Then growth drops from year 4 thereafter to maybe 6%. We are told that the market rate is 16%. So calculate the value of stock now. So we can use a number line to illustrate this for you. So 0, 1, 2, and 3. The growth rate for the first 3 years is what? 8%. So the dividend now that has been declared is 10 kwacha. So we need to calculate the dividend for year 1, year 2, and year 3. Then starting from year 4 thereafter, the growth rate in the second phase is at 6%. The market rate for both is 16%. So we now need to calculate it in phases. So this guy here, using the growth rate, is able to find the future value for each of these 3. Who remembers, how do you find dividend for year 1? How do you find dividend for year 2? And how do you find dividend for year 3?
So to get the dividend, we just simply take the previous dividend, 1 plus the growth raised to the power t.
Good. So here we have 10. The growth is 8%. So the time difference here is 1. So year 1 is going to give us 10.8. Are we together? So this is the dividend for year 1, 10.8. Now I can teach you a shortcut, which is it's going to be very useful to you. Ideally, year 2, we're going to do what? D0, 1 plus growth to the power 2. So here we have 10, 1.08 to the power 2, isn't it?
Yes.
1.08 to the power 2 times 10 is giving us what? 11.66. But if you're lazy, you can just multiply the previous answer here, because this is 8%. So you'll be multiplying your next answer by 1.08. So just multiply the 10.8 times 1.08. 10.8 times 1.08. You get 11.66. Now 11.6 times 1.08. Just multiply 1.08. It will give you the next figure, which is what? 12.60. It's 597, but near 60. Now from year 3 to year 4, the phases have changed. So this growth rate is what? 6%. So we're no longer multiplying by 1.06, 1.08. Instead, we're going to multiply by 1.0 what? 1.0 what? The growth rate is 6%. So I'm multiplying by 0.06, isn't it?
Yes.
Times 1.06. So this is 13.35. This is just an issue of mathematics, just simplified. Enough PTFO, just use the same grade 1 way. Growth dividend for year 3 is D0, 1 plus growth to the power 3. So up to Arabic at 10, 1.08 to the power 3. And this will give us what? It will give us 12.60. Number pali here 4, D4. What was actually happen here is D0. We can't use D0 because we can't start from here. This is a new phase. So you start from D3. D3, 1 plus growth to the power what? The time is 1. So the previous answer is going to be important here, 12.60. Then here 1 point, instead of 0.8 now, the phase has changed to 6%. So 1.0 what? 0.6 here to the power 1. So what it will give you here is what? 13.35. So far, are we together?
Yes.
Any questions, anyone? Please ask now before I move. Okay, so now, apa pen apa. Wala chako, something very peculiar. So we can calculate the value of stock for phase 1. We can call this phase 1 by discounting these ones. So we divide this one by the 16%. So we want to calculate how much is this one today. We're going to divide this one by what? By 1.16 to the power negative 1. 1.16 to the power negative 2. 1.16 to the power what? 3. If you're dividing, don't put a negative, but if you're multiplying, just dividing this. So we want to know what is the value for this. What's the value for that? So E, to if we divide by 1.16 to the power 1. E by 1.16 to the power 2. E by 1.16 to the power 3. The total of each of these ones will give you the value of stock for phase 1. We're like discounting these figures there. So 1.08 divided by 1.16 to the power 1 here. This is 10.8 divided by 1.16 to the power 1. So this one is actually with the value of this one is not 10.9, it's actually 9.31. This one as well, 11.66 divided by 1.16 to the power 2. This one is actually the value is 8.66, 8.67. This one here, 12.60 divided by 1.16 power 3 is actually with 8.07. So the value of stock for the first phase, when we total up these three, 9.31 plus 8.67 plus 8.07 will give us a value of phase 1, which is 26.05. Now, Sanga just for the phase 1, that will push. Phase 2, it is growing at 6% thereafter. So we're going to use Gordon's method. Gordon's method says, it's like this is year 0 and this is year 1. So we're looking at the value of stock as at year 3. So year 3 is equal to what? D1. You can just say D4 over K minus what? Minus G. So we want to find the value. We need to reverse one step backwards for this one. So we want to value the value of that one. So what is our D4? 13.35. The K market rate is 16%, 0.16. The new growth rate is 6%, so 0.06. So here we just divide 13.35 divided by 10%, 0.10. So you're going to have 133.5. 133.5. So this is the value of stock as of year 3. So value of stock as of year 3 is 133.5. So we also need to discount this one to today's date. We're going to find the value of stock. So this one also we're going to divide by 1.16 to the power what? 3. Apanga at your 5 years, they've also brought it back by one step, would have been V4, then 1.1 would have been the power 4. This is where most of you get it wrong. Are we together?
No, just kindly repeat what you said.
So phase 1, are we together how we found this guy?
Yes, I understand.
Phase 2, we can't use the constant growth model because this is growing perpetually. So 6% thereafter. So now step 1, we need to calculate the value of stock using Gordon's rule. Gordon's rule says V0 is equal to D1 minus K minus G. So E, this is A4, A3. Remember, they follow each other. This is 0, there should be 1 there. So I'm just using the same numbers that are there. So we want to find the value of stock as of year 3. So V3 is equal to D4, which is this figure, 13.35, K minus G. So 13.35, the K was what? 16%. The growth was 6%. So 16% minus 6% is 10%. So 10% into 13.35, we're going to get 130 what? 133.5. Remember, this 133.5 is the value of stock as of year 3 upper. If I rate it up. Now we need to discount this one. The only factor that is used to discount is the what? The appropriate discount rate. So we need to discount this one here because 133 is in the 3rd year. We want to know how much it is worth today. So we need to divide 133.5 divided by 1.16 to the power 3. So 133.5 divided by 1.16 to the power 3. So this one will give you what? Will give you 8 what? 85.53. 85.53. This is the value of stock now for the second phase. So our values of stock now is phase 1 and phase 2. So we need to calculate this and find the ultimate value of stock. So plus 26.05. So we're going to get 111.58. So this is the value of stock ultimately. So this carries 12 marks or 15 marks because it is that tedious. It is that tedious. So I'm giving you, I only took 4 minutes to do that. 6 minutes. Example. Calculate the value of stock for this one. Take your time. Zambi for stock growth rate is 16% for the first 3 years thereafter. It drops to 8%. Just received a dividend of 3.24 per share. Appropriate discount rate is 15%. What is the value of stock? 15 marks. Take your time. Zambeef has an expected growth of 16%. So what is that? Our G1. Our G1 is what? 16%, 0.16, right? For the first 3 years, 1 to 3 years. Then 4 years plus, the growth rate increases, drops to 8%, 0.08. We just received the dividend. So D0 is what? 3.24. The appropriate discount rate, so our K is what? 15%. Are we together with the entire information? Are we okay with this information? Then we establish a number line. So we have 0, 1, 2, 3, 4. So dividend year 0, we have what? 3.24. The interest, the growth rate is 8%. So here we're talking about 8%. So I said the quickest way is just to multiply each entry by 1.08.
That's 16% there.
Or
The
16%.
growth rate.
That one is 16%. Thank you. 16%. So we're going to be multiplying by what? 1.16. So 3.24 times 1.16. What are we getting for the year 1? we're getting 3.78. Or to be precise, 3.7584. Again, this answer multiplied by 1.16. We're going to get 4.3597. Again, this one we're going to multiply by 1.16. We're going to get what? 5.06. Figure out the mean. Now the next phase is declining from 16% to what? To 8%. So what am I going to multiply this one by? 1.08. Are we together? So times 1.08. So here we're going to get 5.46. Did we get these figures? I'm trying to use the simplest way to completing our number line. Did we get these figures?
Yes.
Then to discount each of these ones, we're going to use the market rate. Our market rate is 15%. Okay? So we're going to divide this one by what? 1.15 to the power 1. This one, 1.15 to the power what? 2. This one, 1.15 to the power what? 3. So that we get the discount rates for each of these ones. So this one, it will give us, this one will give us a figure, this one will give us a figure for phase 1. So let me start with this one here. 3.7584 divided by 1.15 to the power 1. So this one will give me 3.27. And I also divide this one 4.3597 divided by 1.15 squared. I'm going to get 3.29 or 3.30. And lastly, this one, 5.06 divided by 1.15 to the power 3. I'm going to get 3.33. Pripamo? 3.27 plus 3.30 plus 3.33. When I total these ones up, I'm going to get 9.90. There will be a few alterations, but the range is within the same. So if it's KFI, to calculate the first year. So let's check for year 1, year 2, and year 3. So these ones are the figures we're looking at. So 3.27, 3.30, and 3.33. Is that what we got? 3.27, 3.30, and 3.33. So this is exactly what was found here. 3.27, 3.30, and 3.33. This is for phase 1. Are we together?
Yes.
Yes.
Then what do we do in phase 2? How do we treat this guy? Who remembers? We use Gordon. V3 is good what? D4, K minus what? Minus G. So what is our D4? 5.46. What is our K? 15%, so 0.15. And what is our growth rate for the second phase? 8%, 0.008. So 15% minus 8%, we're going to get 7% or 0.07. So we divide 5.47 over 0.07. 5.6.
46.
Put out 47 on my board. Divided by the answer, we're going to get what? 78. This 78 is the value of stock as of year what? As of year 3. Are we together? So as of year 3, plus 78, so we need to discount this guy, the 78. How do we discount the 78? By dividing 1.15 to the power 3. Are we together? So when we discount that, it will be 50 what? 51.29. So we add 9.90 plus that answer, we're going to get 61.19. So I'm getting 61.186 or 61.19. The range of the answers depending on how you get it. Okay, so here 61.22 is what they got. I've gotten 61.19. All these are within the same range. So this is how to find the value of stock. Is that clear? Let's go to the exam. Then we end our day. Kasuba Solar Company sells solar electricity throughout the Katanga region. Because of increased mining activities in the recent years, the company has prospered and expects to do well in the near term. The company will pay 0.75 a share to dividends 1 year from now. So I need you to understand what has been given there. Investors believe Kasuba Solar will increase that dividend at 15% per year for the subsequent 5 years before settling down to the long-run dividend growth of 3%. Dividends expect 8% return on Kasuba Solar common shares. What is the selling price of the stock? 10 marks. Whatever happened in the exams, whatever erodes your mind, I do not know. So let's analyze what has been given here. Charlotte, what has been given? What is this guy? 0.75. Is it D1 or D0?
That's D1.
D1.
Because of the 1 year from now. Correct. That's D1. I'm happy that you're able to see that. What else are we given? So we're going to use a number line. Icon can be is 0. So this question was a little bit, it was actually tricky. 1, 2, 3, 4, 5, 6, 7, 8. So call it D1, we're going to put what? 0.75. Then it is expected to grow at what percent? 15% for the subsequent 5 years, range. The next 5 years. This is 1, 2, 3, 4, 5. So this growth will expire in the 60th year. So this phase here will be multiplying the answers by what? 1.15, right? We're making a mistake of ending it here. Before settling to a growth rate of what? 3%. So we'll be multiplying the answers by 1.03. Are we together? So 0.75 times 1.15. The answer is 1.15 up to here. The answer multiplied by 1.03. Are you getting the picture? Then the KD is 8%. KD is 8%. So what follows? I'm confident you're going to do that. I need my work by tomorrow. You can screen grab this. I'll end here. Any questions? Please speak now or forever hold your peace. So today we did bond valuation. In the evening, we done stock valuation. The other day we did time value of money and we did amortization. So the other group did cost of capital. So we're going to do cost of capital, risk and return, and dividend policy. Then we are done with the syllabus. So by next week, within two weeks, we are done with the syllabus. Then the other weeks, we are just going to be revising. Is that clear?
Yes.
So I'll send the video in the premium group. So I'll end here.